Top real reasons to invest in gold. Not price. Historical crisis performance. Gold's safe haven reputation comes from documented performance across many crisis types. The pattern repeats consistently. When uncertainty rises and traditional assets stumble, gold tends to appreciate or at least maintain value. The 1970s stagflation period provides a particularly relevant case study for today's environment. As oil shocks drove inflation higher and economic growth stagnated, stocks and bonds both struggled. The traditional 60-40 portfolio suffered meaningful losses in real terms. Gold, meanwhile, surged from $35 per ounce in 1971 to over $800 by 1980, preserving and growing purchasing power while other assets floundered. The 2008 financial crisis demonstrated gold's crisis characteristics from a different angle. The initial market panic actually saw gold decline slightly alongside everything else as investors liquidated positions to meet margin calls. But as the crisis deepened and central banks responded with unprecedented monetary expansion, gold began a multi-year rally that nearly doubled prices between 2008 and 2011. Investors who owned gold before the crisis began enjoying protection that late buyers missed. More recently, the COVID-19 pandemic created a sharp test of gold's defensive properties. In the initial market crash of March 2020, the S&P 500 fell nearly 34% from peak to trough. Gold initially declined modestly, but quickly recovered and pushed to new all-time highs above $2,000 per ounce by August 2020. The divergent performance provided exactly the diversification benefit that strategic gold positions deliver. Today, you are seeing massive gains in gold and silver as concerns about the dollar's long-term solvency, the U.S. national debt and deficits, and countries' drawdown of U.S. bonds start to grow. Also, the increasing mass accumulations of gold bullion by world central banks have remained steady for the last 10 years and continue to provide a stable floor under the gold price. Universal acceptance and deep liquidity. Some assets offer excellent theoretical characteristics, but lack practical liquidity when you actually need to transact. Collectibles might hold value, but finding buyers takes time. Certain real estate can be difficult to sell quickly. Even some financial instruments have limited markets with wide bid-ask spreads. Gold operates in a different universe entirely. The global gold market trades over $180 billion daily across many time zones and continents. London, New York, Shanghai, and other financial centers maintain continuous markets with transparent pricing and large liquidity. This depth means you can buy or sell meaningful positions without materially affecting the price or accepting unfavorable terms. The practical implications extend beyond just trading convenience. Universal liquidity creates price efficiency, ensuring you receive fair value based on global market conditions as opposed to local supply constraints. It provides optionality, allowing you to access capital quickly if circumstances change. And it offers geographic flexibility, since gold's global recognition means you can sell in any major city worldwide. This liquidity characteristic distinguishes gold from other hard assets often proposed as inflation hedges. Farmland might protect against inflation, but selling acreage quickly at fair prices presents challenges. Classic cars or fine art might appreciate, but finding qualified buyers willing to pay full value needs time and effort. Gold's liquidity eliminates these friction costs. I just want to briefly interrupt this video to thank you for supporting this channel. Please like and subscribe if you enjoy this video content. It really does make a difference. Also, a quick shout out to one of this channel's sponsors, Augusta Precious Metals. With over a decade in the industry, Augusta is one of the leading gold investing companies for trust, customer empowerment, and prices. The company provides investment account rollover services to tax-advantaged gold IRAs, as well as a unique educational webinar and resources for their customers, helping beginning and experienced investors protect their retirement wealth with confidence. To learn more about Augusta Precious Metals, see the link in the video description to visit Augusta's official site to receive a free investing guide. Also, check out our video review of Augusta Precious Metals by clicking the link in the top right of the screen. Now back to the video. Now for some gold investing strategies that actually work. Dollar cost averaging provides the most straightforward approach for most investors. Rather than attempting a single perfectly timed purchase, you commit to buying fixed dollar amounts at regular intervals, perhaps monthly or quarterly. This method automatically buys more ounces when prices are lower and fewer when prices are higher, smoothing your average cost over time. The psychological advantage of dollar cost averaging shouldn't be underestimated. You eliminate the pressure to forecast market bottoms or worry about buying before correction. Instead, you're systematically building a position regardless of short-term price movements. This aligns perfectly with gold's strategic purpose. You're gradually establishing protection, not trying to trade it. Portfolio allocation percentages need personal consideration based on your specific circumstances, but the 5 to 15% range appears in recommendations from various financial institutions and advisors for good reasons. Below 5%, the position may be too small to provide meaningful diversification benefits during market stress. Above 15%, you're potentially allocating too much to a non-yielding asset at the expense of growth opportunities. Your allocation within that range should reflect several factors. Proximity to retirement matters. Closer retirement might justify higher allocations for protection. Inflation concerns play a role. Higher inflation expectations support larger positions. Geopolitical risk assessment factors in. Greater uncertainty argues for more defensive positioning. Overall risk tolerance influences the decision. Conservative investors might prefer higher gold allocations. Avoiding common implementation mistakes. The first major mistake involves confusing gold exposure with gold ownership. Gold mining stocks, gold mutual funds, and gold ETFs all provide price exposure nominally to gold, but they introduce counterparty risk and correlation to equity markets that physical gold ownership avoids. Mining stocks often underperform gold itself because of operational challenges, regulatory issues, and general equity market correlation. ETFs depend on institutional solvency and proper metal backing. These paper gold choices offer advantages in tax-advantaged retirement accounts and provide convenient trading, but they fundamentally differ from direct physical ownership in ways that matter for gold's core strategic purposes. A comprehensive approach might include both physical holdings and paper exposure for different roles within your overall allocation. The second mistake involves inadequate attention to storage and security for physical gold. Home storage provides immediate access and eliminates storage fees, but it introduces theft risk and potential insurance complications. Professional vault storage offers high security and insurance, but it adds ongoing costs and needs trust in the storage provider. The optimal solution depends on position size, personal circumstances, and risk preferences. Gold IRAs are a tax-advantaged way of owning physical gold and silver without the need or liability of storing the actual precious metal in your own residence. These gold IRA companies provide lifetime customer support, competitive price matches, buyback guarantees, low fees, and secured storage. See the links in the video description to find the right gold IRA company that fit your individual needs. Fill out their short contact form and receive a free gold IRA guide. The third mistake centers on buying gold from inappropriate sources at excessive premiums. Reputable dealers charge modest premiums over spot prices for standard bullion products. Less scrupulous operators charge far higher markups for rare or collectible coins that don't offer extra benefits for investment purposes. Focus on recognized bullion products, American Eagles, Canadian Maple Leafs, or standard bars from established dealers with transparent pricing. To sum it up, gold's value in your portfolio has nothing to do with predicting price movements. The metal maintains purchasing power, reduces correlation to traditional assets, eliminates counterparty risk, provides crisis protection, and confirms liquidity. Trying to time gold purchases represents a basic misunderstanding of its strategic purpose. Implementation through dollar cost averaging at suitable allocation percentages, 5 to 15%, depending on personal circumstances, provides the practical approach that aligns with gold's characteristics. Physical ownership offers the benefit of security that paper choices can't fully replicate, though both may play roles in a comprehensive strategy. The investment sophistication required to use gold properly involves recognizing that some assets exist for protection, diversification, and wealth preservation across generations as opposed to growth. Mastering this distinction elevates your entire approach to portfolio construction, beyond simple return chasing and moving toward genuine risk management. Please like and subscribe if you enjoyed this video content. Thanks for watching.